Please pay close attention. The next 30 seconds could make up for all your stock market losses this year and even save your retirement. On September 22nd, you'll have a rare chance to hear from two Wall Street legends, Mark Chaikin and Joel Lippman. Mark spent 50 years on Wall Street, where he worked alongside the likes of Paul Tudor Jones and invented one of Wall Street's most popular indicators, a stock picking system that appears on every Bloomberg terminal in the world today. His biggest fans include CNBC's Jim Cramer, who said he's learned the hard way never to bet against Mark. Meanwhile, Joel Lippman is a forensic accountant who spent the last 30 years denouncing Wall Street. He predicted the crash of 2008 months before it hit, and his insights are in such high demand, he's been invited to speak at Harvard, the FBI, and even the Pentagon. What Mark and Joel are going to share with you on September 22nd could make or break your retirement. A way to 5x your money, even if the market crashes another 20% this year. And they say what's coming before the end of the year will create and destroy fortunes, depending on which side you're on. Let's face it, the stock market's been a minefield this year, with the biggest sell-off we've seen in 50 years. And thanks to inflation, even cash isn't safe anymore. Your money is losing value, even as we speak, at a rate we haven't seen since the 1980s. If you want to survive this disorienting market, then don't miss Mark and Joel's big reveal on September 22nd. They'll be giving you a financial lifeline that could erase this year's losses for you and trigger a wave of potential wealth that's so powerful it could save your retirement. And you don't have to wait until September 22nd to get started. For a sneak peek of Mark and Joel's big reveal, go to perfectstock2022.com. Again, that's perfectstock2022.com. Hi, this is Daniela Camboni, and welcome back to the Daniela Camboni Show here on Stansberry Research. Well, we are seeing volatility in the stock market ahead of a very important Fed decision. Joining me today to talk about this and much more is Genevieve Roch-Decter. She is the founder of Grit Capital. She used to manage a $100 million fund. Now she says she invests for herself. Nice to meet you. Welcome to the show.
Great to be here, Daniela.
So let's talk about this rocky road for stocks. I know you say, I don't know why everyone's complaining when it's on sale. What's your take on this here ahead of the Fed?
Yeah, look, we had this crazy euphoric bear market or bull market in 2020, 2021, and now we're seeing the polar opposite. It's one of the most pessimistic bear markets that we've seen in decades. And, you had a situation with money was free flowing, the cost of capital was super cheap, and now we're entering, quantitative tightening, and capital is getting more expensive, and people are scared. Stocks are down, bonds are down, crypto market's down, private equity is down, venture capital is down, like everything is pretty much down. The only bull market we're really seeing out there is the US dollar and European energy prices. So I think what happened last week, we had, massive sell-off, of course. The S&P was down 4% on a single day. But what I found interesting was that the volatility index, the VIX, on that day when the S&P was down 4%, it didn't spike over 30, which told me that that was a very complacent sell-off, almost expected, not a surprise. Big money managers are not that they're not concerned, but they just sort of expect this. And, to your point, going into the Fed meeting on Wednesday here, we're probably going to see a 75 basis point increase, and no one's really going to be surprised by that, I don't think.
So is the bottom not yet in for the S&P?
I don't think it is. I don't like to make short-term predictions. Right. But I do think we're going to either retest the lows or make new lows. I don't see any near-term catalysts here. The only thing maybe we could see in December is a Santa Claus rally into the end of the year, which is typically when the market likes to rally. But to get back to even on the S&P, we'd have to go up 1.5% a week. I just don't see that happening. And, there was an interesting chart that I put up last week about institutions hedging out their exposure to the market, which was 3 times what it was in 2008 last week, which I thought was very fascinating.
Yeah. What's that telling us?
It's telling us that they're again, I don't think they're seeing a near-term catalyst either. I think things are so dire in Europe. We've entered a recession in America. Inflation is still running high, although we've seen 3 consecutive months of it going down, which I think is positive. But it's still running at over 8%, which is just, horrible for consumers at the pump and in the grocery store and everything. So I just think that there's no near-term catalyst here. But the good news is that if you're a new investor getting into the stock market, or you've got cash on the sidelines, most wealth is created in bear markets. It just feels like hell at the time.
Right. And I want to stop you there because that's a crucial point. If you're a new investor, or if you have cash to invest, like you said, could be a great opportunity. But what about those folks that are maybe, in their 60s, in their 70s, they're preparing for retirement, they're preparing for wealth transfer. They're thinking, when am I is this gonna come back? When am I gonna see my money here again?
Yeah, and that's when you do have to have a really good wealth manager that you're talking with. But yeah, for baby boomers who are looking to retire soon, who need that income stream, stocks right now are volatile, so probably not the best place. And bonds, although I would never recommend bonds for new investors right now, just given what's happening with inflation and what's happening with the stock market, it might be a place for baby boomers to actually be able to get a return, maybe not a real return, but a return. I tweeted last week that the 1-year treasury rate for the first time in 15 years hit over 4%. So, a real return for 1 year, if inflation's at 8%, is -4, but that's still better than what you're getting in a savings account right now. I think the average savings account interest rate in America is 13 basis points.
That's interesting. You say you wouldn't normally recommend bonds, because I've had a few experts on saying that's the only thing that they're buying right now. Why would you say you normally wouldn't recommend it?
Well, I'm looking to, compound my return over decades. I'm looking for growth. I'm a young investor. I have like 30 to, 40 years ahead of me in terms of making my capital grow. And so I'm looking for growth. I'm not looking to just make, 4% on a 1-year treasury right now.
Okay, like I said, we're speaking ahead of the Fed, and I want to just bring up one tweet. You recently said that I think really just sums up, the sentiment of the Fed right here. You say, look, the Fed is really, really in a tough spot. They raise rates too little, inflation persists. Raise rates too much, the economy enters a recession. Finding that sweet spot is like finding a needle in a haystack. Where's their mindset at now?
I think their mindset at now is that they want to tame inflation at any cost. I think they realize how difficult this is for, the average American, to have the price of groceries be up, 10-15% year over year. The price at the pump is so high. It's just squeezing them over and over again. And wages haven't kept up with this inflation. And so, real returns, their income is diminishing. And this is terrible. And so I think, inflation would have caused the economy to come to a halt anyways. Interest rates is just kind of taming it sooner. So they were late to the game, as everybody knows. And so now they're just playing a game of catch up.
I want to talk about, like we were saying, everything just seems to be melting, S&P, Bitcoin, gold. It seems like nothing is safe right now. Where would you be placing your bets? And then I want to talk to you a little bit more about gold, but any sectors that you're liking right now?
You know what? I'm keeping my money in large cap dividend paying stocks. Really boring. Boring is sexy right now. So I've got my money in financials. Yeah. Typically in an interest rate hiking environment, financials are supposed to do well, relatively well, because you get a net interest margin expansion, between the costs that they're earning on their capital and the costs that, they're paying out. So one stock that I really like right now is Brookfield Asset Management. They're one of the largest alternative money managers in the world. They've got a lot of cash on their balance sheet. So any company right now, whether it's, Berkshire Hathaway with a lot of cash on the balance sheet, anyone with a lot of dry powder, this is such an opportune time for them to acquire assets on the cheap. So I'm also invested in Berkshire Hathaway. So I'm really interested in those companies that are going to be opportunistic right now and buy assets on the cheap, whether that's beat up real estate companies, beat up asset managers, beat up infrastructure companies. I think if we're going to look back over 5 to 10 years, this will mark a time where, smart money got smarter and got nimble. So yeah, in terms of, other areas in the market, obviously commodity prices have been elevated. I've been very vocal since June that I didn't think that WTI prices, so, the price of oil in America was going to keep climbing. And in fact, it hasn't. It's down 33%. And I warned my investors who read my newsletter just not to chase this trade. Don't chase these energy producers. I think the easy money's been made. And, I'm not right about everything, but that was one that I did actually get quite right.
Well, to that point, would you chase the US dollar trade?
I wouldn't chase the US dollar trade either. I mean, it's 20-year highs as well. It's like you can't, I never like to chase themes or chase trends. And so I think I'm just watching this one from the sidelines. The US dollar obviously is a safe haven trade right now. People are sitting in cash. People are chasing yield. As interest rates in the US are going up, capital flows to the highest return globally. And, we've seen in Europe they're increasing rates, but not as fast as the US is. In China, they're actually cutting rates to try and stimulate their economy. So completely different scenario over there.
You pinpointed gold in one of your recent tweets saying, anyone who's saying it's an inflation hedge, in your opinion, gold is failing?
Well, I made the joke that, a lot of, I would say probably older money managers like to tell their clients that, gold is a great hedge against inflation. And so I kind of asked myself if a year ago, one of these wealth managers told me inflation's going to run at the highest rate in 41 years. You should probably buy gold. I would have probably thought, yeah, that sounds like a compelling argument. But then the scenario has played out and gold's just officially entered a bear market last week. Obviously, that has a lot to do with the fact that, US dollar has gone up so much. I've never been a proponent for gold. I understand why institutions hold gold and family offices do, wealth preservation. A lot of these places are looking to just, conserve capital, not make money off their money, but just conserve it. But I've got a different game plan for myself. I'm looking to compound returns.
Okay. Do you feel the same because talking about buying opportunities, what about some of the gold and precious metal miners out there that are just so cheap right now?
Yeah, I haven't taken a look at them. I really haven't. I've preferred to own in the commodity space things like copper producers, things that are more, directly correlated to economic output. So, when the economy is roaring, you got copper with a PhD telling you that, things are going to get better. But obviously copper is down now. It's down 30% from its highs. So things are not looking like they're going to get better. But yeah, I would actually love to talk to somebody about gold because I haven't dug down super, super deep on it. And if it is in fact an opportunity, just like to get educated on it, but don't have anything to say about it right now.
I have many people I could connect you with if you'd like to have that conversation.
Peter Schiff, maybe.
Happy to do so. Okay, final point. You had mentioned Europe and how you feel it's just in a dire situation right now. How bad is it? Because I brought this up with one of my guests last week that I feel we're seeing so many divergent headlines with how the situation will be this winter with the gas shortages. Goldman Sachs coming out saying, "Don't worry, the oil prices won't spike as high as we think." And then another headline saying the complete opposite. What's your take? How bad can it get, or not?
I mean, I think it's already terrible as it is now. They're saying that some companies in Europe are paying as much for electricity in 1 month that they paid for all of electricity last year. Unfortunately, the fate of European electricity is in the hands of a dangerous dictator who's unpredictable and who's essentially cut off natural gas supplies to Germany. And it's unclear if they're going to be able to, really offset this. They've come out with a number of policies that they want to enact, but I'm not sure, if they'll be able to pull it off. Like their storages are getting, more dire and dire and dire. LNG imports from the US to Europe have spiked. Now they're going to China to import LNG supplies. So I don't know. There's too many moving parts really to call it here, but it looks like it could be quite scary heading into winter if you are over in Europe right now.
Genevieve Roch-Decter, I really appreciate your thoughts. Any final words of wisdom for all the folks watching at home?
I would just say that, over the last 100 years, the S&P, it's survived every war, depression, recession. It's compounded returns at 7% a year, 10% with dividends. So zoom out, take a long-term view. And when the market's down, it is a good time to go shopping, even though it doesn't feel like it.
I appreciate your thoughts. Come back soon. It was great chatting with you.
It was excellent. Thanks, Daniela. I will.
All right. And thank you all for watching. We'll have much more coming your way, so be sure to stay tuned to Stansberry Research. In the meantime, don't forget to sign up at danielacamboni.com so you can stay on top of all these fantastic interviews. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.